Well, you hear it all the time. If you plan to accumulate wealth, you should not be saving your money in a bank. Why? Because the savings accounts of banks typically pay an interest rate less than that of the inflation rate. So, for example, right now the inflation rate in 2023 is quite high, hovering close to that 6 to 8%. And in most cases, the interest rate that you get on a savings account is at most perhaps close to that 3 to 4%, and in many cases even less than that. So what are your alternatives? Well, you hear the options that you need to be investing your funds and your savings into assets that accumulate cash flows, assets that grow in value over time. And through that, you manage to actually accumulate wealth and grow your wealth. These could be things like real estate, whether it's a rental property or real estate investments, could be stock market investing, whether it's investing in dividend stocks, growth stocks, or even passive investing options. But even beyond that, some alternative investing options, such as investing in gold, investing in precious metals, even cryptocurrencies, you name it. There's so many options out there. In this video, I'll be sharing with you why I have selected investing in the stock market passively as a comfortable way of accumulating wealth and growing my wealth over time with the goals of reaching and achieving financial independence in the years to come. Well, hello everyone. My name is Mo, and on this channel, Momentum Finance, I talk about the power of investing and ways to reach financial freedom through investing in the stock market. I've selected investing in the stock market because over hundreds of years, stock market has proven to be a wonderful wealth generation tool that allows investors to grow their investments and savings over a long enough span of time. When you're considering investing in the stock market, you shouldn't have a short time frame, because that could be really add to the risk involved with that, because the chances are in the short term your funds might go down in value. But if you're in there for the long term, over long enough span of time, we're talking about 20 or 30 years time frame, that's a sure way to accumulate wealth and grow your savings and your funds. And we are looking at it with that long-term horizon. When it comes now to investing in the stock market, there are ways for you to do that. One way to go about it is really trying to pick individual stocks, the companies that you are familiar with, the companies that you've done some research on, and you want to invest in them. And well, that could be a lucrative way for investors if they manage to pick the winning stocks, those that are able to 2x, 3x, or sometimes 10x in terms of valuation. The risk associated with that is that it's really can be difficult to pick winning stocks constantly and repeatedly over time. You might be doing your research and be really lucky in selecting maybe a few stocks that are doing well, but the chances are in those basket of stock that you're picking, you might have a few that also do very poorly, and then those can really drag down the performance of your accounts. Now, I'm not saying that there are not investors who can nail this. Perhaps there are ones who can do this successfully, but for the most part, I would say easily 90 to 95% of investors are not able to constantly and repeatedly beat the average returns of the market. And the average returns of the market could actually be quite a great return for most investors. The stock market over long enough time frame has returned on average anywhere between that 8 to 10%, which is just really reasonable returns for investors compared to the type of returns that you're going to get if you put your money in a bank account. So I just really want you to kind of reframe your mindset of the average return is not necessarily a bad thing. The word average, in fact, it could be a really good thing, knowing that the other side of the story could be that if you were to just blindly pick stocks, or even sometimes after research having to pick stocks, you might end up really losing a lot of money doing so. And in many ways, it might not be because of the known factors. It could be because of some of the unknown that you're not aware of, or sudden change into the dynamics of the market. I'll give you a good example from my own experience. Back in 2018 and 2019, that's when the economy was doing very well. The economy was booming, and the whole stock market was actually flourishing. And that's when I decided I want to actually invest in a company called Boeing. I think we all heard about it. I bet you everybody watching this video has at least once flown on a plane made by Boeing. Boeing was doing very well at the time. They were paying a dividend. They had a long history of paying their dividends. They were also a stock that had been nicely growing in terms of valuation. So at the time, I decided to put some funds and buy shares of Boeing company. Now, fast forward a few months later, there were some sad incidents with Boeing planes. There were some manufacturing of the planes, and it resulted in some casualties and definitely some fatal incident that happened at the time. That really took a toll of the Boeing stock. The stock started to pull back, considerably. But at the time, again, it was a one-off incident, and those are the type of things that for an aviation industry and business, it could happen in years. So I used that as an opportunity to buy more shares of Boeing at the time, bringing my dollar cost average down. But then we all know what happened. We had the 2020 and the pandemic that we had, and the outcome of it was that the whole economy of the world was really impacted negatively. The lockdowns, and you had the tourism industry and the consumer discretionary industry being impacted negatively. And of course, that took a massive toll on the Boeing stock. So much so that the valuation of the stock of Boeing almost got halved in a matter of years, like more than 50%. At one point, I think my stock was down more than 50 or 60%. So the way that I try to do that, still I approach it by trying to buy more shares of Boeing, try to bring my cost average down. I believe I managed to bring the cost average down by almost $60 to $70 per share by buying more shares of it. Currently, the shares of Boeing, I think, are hovering around that $212 or $210 mark at the time of making this video, whereas my average price still, after being very diligent and trying to bring it down, is still hovering close to that $240 or $250. So I'm still down around that 20 or 30% down. Considerable amount to be fair with you. Long story short, the reason I shared this story with you is that even after having done a lot of research, there were so many things that were outside of my control, and I couldn't have possibly imagined or anticipated such a thing is going to happen. That happened maybe once in a lifetime, or maybe once every 10s or 20 or 30 years. Had I instead invested passively in the market itself, I might not have had maybe the amazing gains had I picked, let's say, a winning stock like Tesla at the time, or Apple, or some of those type of companies. But at least I wouldn't have had to wait for many years and still being down on that stock for 20% or over for many years. My story, kind of the conclusion to that story, is that the average returns really can be okay and really comfortable with many investors if you don't want to take that much of a risk and you don't have that level of risk tolerance and maybe the patience. In this case, I had the patience. I am still holding on to the stocks, but had I known better, perhaps it would have been a wiser idea to just buy into the market. And the way that I'm doing it right now, in fact, I've built a portfolio of close to $420,000 in value, hovering around that, mainly investing in 6 high-quality growth and dividend index funds. These are very much low cost fee indexes that gives me exposure geographically diversified, as well as the diversification to sectors and diversification to different funds, both in terms of Canadian and US dollars funds. And in this video, I'm going to be sharing with you these specific funds that I have. For those of you who've been watching our journey and our channel, you know about these funds, but I would like to share with you the latest returns, where we are at, and what's the plan for this portfolio. Though, to be honest with you, this is my main portfolio that I intend to grow into a much larger position. I intend, as I have more funds, buy more shares of these high quality 6 dividend and growth funds that I'll be sharing with you momentarily on the screen. Let's get into it. All right, so here's a quick look into these 6 funds that we have. We have the VDY, which is our largest holding. That's indeed the Vanguard FTSE Canadian High Dividend Yield Index ETF. For investors who might not be familiar, VDY gives us exposure to around that 50 top high dividend paying companies in Canadian market. These include banks, financial institutions, energy sector, you name it. It's kind of, you get some exposure throughout the different sectors, but mainly focus on companies that pay dividend. This accounts currently for 42% of our portfolio size. And we have invested close to $180,000 into VDBuy. It does pay a monthly dividend, and we are currently up by 5.4%. It has a fee of 0.22%, fraction of a point, definitely way better than any of mutual funds or sometimes the fee that you pay to your financial advisor. The next big holding that we have is VFB, or Vanguard S&P 500 Index ETF. Although this fund is available in Canadian dollars, it gives us exposure to the 500 largest companies in the Standard & Poor's US index. We have 102,000 almost invested in it. Between my wife and I, it accounts for 24% of our portfolio. It does pay its dividends on a quarterly basis. It's not mainly intended for dividend, but it does pay kind of about 1 or 2% dividend yield as well, hovering more so close to that 1.5%. As for our third large holding, it's V Equity, VEQT. It's another offering by Vanguard. It has a fee of 0.24, which is the highest fee among our 6 picks. But with VE Equity, the reason it charges you a higher fee is that it gives you that diversification geographically throughout the international world. Like, you get exposure to Canada, you get exposure to the US, but also you get exposure to the international markets. It's a all-in-one basket ETF, pretty much simplify things for you. We are using V Equity in our Smith Maneuver portfolio. Currently, we are down 2.2%. It accounts for 23% of our portfolio. And with V Equity, it does pay its distributions only once a year. The next one is due for January 29th of 2024. We are intending to also get some exposure to international and emerging markets, and that's how we do it through XEF and V. Both of them hovering close to 5% of our exposure at this time. With XEF, it's an offering by BlackRock. It's indeed the iShares Core MSCI East and Far East Index ETF. It is showing to be up by 8.4%. It's the best return funds for us alongside V or Vanguard FTSE Emerging Markets All Cap Index ETF. It's also up by 8.4%. With XEF, it does pay a distribution on a biannual basis, whereas V does pay its distributions on a quarterly basis. Lastly, our sixth holding is XIC. It is iShares Core S&P Toronto Stock Exchange Composite Index. The XIC gives us exposure to the entire Canadian stock market. It has pretty much a good sample of the majority of the Canadian stock market major indices on the Toronto Stock Exchange. And we have 211 shares of it, currently accounting for 2% of our portfolio. This portfolio, the way it is set up, it's a combination of growth and dividend. It brings us on average per year $11,368 in dividend income. So assuming nothing changes, without even buying any more shares of these funds, by maintaining these funds, we can anticipate to get over $11,000 in dividend income per year, which is quite nice. That averages about $947 in dividend income per month, and the daily average dividend of approximately $31. Not bad, eh? And our approach through this portfolio is, as we collect these dividends, we will reinvest. We are almost using that approach of DRIP or dividend reinvestment plan. Some are automatic, some are manual, but long story short, we are reinvesting the entire amounts, buying more shares of these high quality 6 funds that we have here. We do have, in terms of geographical exposure, currently 51% exposure to Canadian businesses, 34% to US businesses, and 16% internationally. And we want to tilt this over time to make it 40-40-20. 40% Canadian exposure, 40% US exposure, and 20% in international exposure. The way we want to do that, as we put more funds and we collect these dividends, we want to buy more shares of the US ones and international ones, minimizing gradually over time our exposure to the Canadian markets. This portfolio currently has a yield of 2.6 or 2.7%, and currently sits at $427,137. Not bad at all. It's up by 3.5% or up $14,611. What do you think of this video and our portfolio that we shared with you? Are you currently investing in the stock market? Let us know if you're investing more passively or actively. I would love to hear from you. If you have any question about the portfolio I shared and all of the initial thought process that I kind of articulated and shared with you on this video, leave us a comment. I would love to hear from you. I'll go through the comments one by one and try to really respond to them individually. Thank you so much, everyone, for watching this video until the end. My name is Mo, and I hope I can see you all on this channel, on our Momentum Finance, in the coming weeks. We post weekly videos about investing, including investing in the stock market, dividend stock, growth stock, passive investing through ETFs, as well as discussing ways that you can reach FIRE, financial independence, and retire early. Thank you, and I hope to see you all next time.